for months, there's been a lot of talk that Calgary's real estate market would be cooling off by now. Some were even predicting that prices would start falling. But here's the twist. That's not what's happening. In fact, the latest numbers are showing something completely unexpected, and it could change the way buyers and sellers navigate the months ahead. So, what's really happening and how long is this going to last? Let's dive in. But first, my name is Dawn, and you know what's crazy? 84% of you now watching aren't subscribed. If you find any value in my videos, please consider subscribing. It would really help me get them out there and grow this channel. In return, I will continue to show up making my videos that I hope you find valuable. My goal this year is 1,000 subscribers, and your support means a lot. Let's start with the numbers because this is where we see the momentum building. As we transition out of winter, activity is starting to pick up. Sales in February hit 1,721 homes, and while that's 19% lower than last year, it's still a jump from January's numbers, showing that demand is increasing as we approach the spring market. That's nothing new for our market here. We also need to keep in mind that sales could be lower because there are a lot of people holding off on making moves because there's just so much uncertainty out there right now. New listings also climbed to 2,830 homes, up 4% from last year, adding much needed inventory to the market. That's about 61% of sales to new listings. Inventory is where things get really interesting. Now, we're sitting at 4,145 active listings, which is nearly 76% higher than last year at this time. And sure, call me a broken record, but that is pretty significant. Despite inventory rising, and something I think some people are surprised about, is prices are still moving up month over month. The total residential benchmark price for February was $587,600, which is up $4,600 over last month. Apartments, row, and townhomes were up slightly from last month, but detached homes and semi-detached both up almost $10,000 from just last month. Semi-detached homes are up 6.9% year over year to 683,600, and detached homes are up 5.1% year over year to 760,500. We've seen prices increase across all price ranges, but the largest jumps were in homes priced under $500,000. That tells us that demand is still strongest at that more affordable end of the market, where buyers are competing for limited inventory. And finally, of course, my favorite market indicator, which is how many homes sold at or over list price in February. Well, that was 571, so 33% of sales. That's up 5% over last month, but get this. Last February, 58% of homes sold at or over list price. So we're definitely seeing a shift. But while prices are still trending up, there's something that happened last year that we need to talk about because if history repeats itself, this momentum might not last. If we rewind to spring of 2024, the market was heating up as expected, but by late spring and early summer, activity started to slow down drastically. And by July and August, we saw prices pull back as demand faded. Last year, the summer slowdown caught a lot of people off guard. So the big question is, will we see the same thing happen again this year? If you're looking for more detail about the condo market specifically, stay tuned. I have a video coming out for that. And if it is out by the time you watch this, you can watch it here. And same for a video specifically about the detached market. We know inventory is rising and prices are holding steady for now, but slightly going up. But there's another piece to this puzzle, one that could shake things up even more in the months ahead. The answer lies in a mix of demand dynamics and the broader economic factors, including interest rates, trade policies, and the Bank of Canada's next move. The Bank of Canada has been on a path of reducing interest rates to support economic growth. In January 2025, they cut the policy rate by 25 basis points to 3%. Looking ahead, many experts anticipate another quarter point rate cut at the upcoming announcement announcement on March 12th, which would bring the rate down to 2.75%. This expectation is fueled by recent economic indicators such as the unchanged unemployment rate of 6.6% in February and the modest addition of 1,100 jobs, signaling a cooling labor market. Beyond what we're seeing in Calgary's real estate market, there are larger economic forces at play, and they could shape where things go from here. One of the biggest topics right now is tariffs and how they're in effect and then they're delayed and then they're on again and then off, and now there could be additional tariffs on dairy and lumber. This is affecting trade, inflation, the job market, and a lot of people have actually already been laid off just with the threat of uncertainty. The Bank of Canada has recently highlighted how tariffs can disrupt trade, driving up production costs, and ultimately making goods more expensive. When that happens, businesses often pass those costs on to consumers, which means inflationary pressures can stick around longer than expected. In turn, this puts the Bank of Canada in a tricky position because their main job is to balance economic growth while keeping inflation under control. But here's the bigger picture. Tariffs don't just impact prices in the short term. Over time, they can reshape entire industries, forcing businesses to adjust supply chains, rely more on domestic production, or even change how they operate altogether. That kind of economic restructuring can have ripple effects, influencing everything from, as I said, employment levels to investment trends, and of course, the housing market. So why does this matter to real estate? Because if inflation stays elevated due to these structural changes, the Bank of Canada may delay further interest rate cuts. If inflation remains stubborn due to trade-related pressures, borrowing costs could stay higher for longer. That would impact affordability, buyer activity, and ultimately home prices. It's one more piece of the puzzle in this shifting market. We have rising inventory, strong demand at key price points, and now the potential for inflationary pressures to stick around due to external factors like these tariffs. As we move further into 2025, these are all things that we'll just have to keep an eye on. For buyers, the good news is that there are more options on the market, but if prices keep rising into the spring, waiting could mean paying more. If rate drops continue, demand could spike again, pushing prices even higher. But we also have to keep in mind that a potential trade war could impact many people's ability to buy, and we could actually see the market soften a bit. For sellers, the window is still open to take advantage of strong prices and active buyers. But if we see another summer pullback like we did last year, timing will be everything. If you're thinking about listing, spring might be your best shot at getting top dollar before things cool down. So with all of these factors at play, rising inventory, strong demand at certain price points, and economic shifts on the horizon, what do you guys think is going to happen as we head into summer? And now, if you're on the fence about whether you should jump into home ownership or continue to rent, I made a rent versus buy video that you might find helpful, so you can go check that out too. As always, if you have any questions, you can text, email, or book a call with me at the link below. I'm happy to help. Thanks for watching, and I'll see you soon.